Okay, here we go. Thanks very much. This is really, really big for us. We're really excited to have David Harkwell here. I'm Chris Mancini. I am the associate portfolio manager of the Gabelli Gold Fund. Um, and with me today is David Harkwell. David is the chairman of Franco Nevada. Franco Nevada is a $25 billion market cap company listed in Toronto and on the New York Stock Exchange. He's been involved in the industry for a very long time. One of the real doyens of the industry, knows it extremely well. So we're really happy to have him here to talk to him about what's going on in the gold mining industry and the royalty industry, and also with the price of gold. One other thing, David, I have to say, is also on the board of the Bank of Montreal, which is, I think, the third biggest bank in Canada. So I promised him that we would not talk about anything Canadian politics, Canadian government, or the lack thereof. So so we'll
Okay.
get started with the gold mining industry and with David. So David, again, thanks so much for being here. Can you just tell us where you're from? So where you were born, where you went to college, what you majored in, and then how you got started in the industry.
Well, Chris, first, thank you. I understand this is the first live broadcast that you're doing, so it's an honor, and it's always a pleasure to talk about Franco, and also I always enjoy talking to people that are knowledgeable about the industry, and you know the history and the people involved, and you've always been a great supporter. So thank you. In terms of my history, I was born in Toronto, so I haven't gone far in life. But I was really born into the mining industry. My dad was a mining explorationist, and he worked for one of the greatest, Thayer Lindsay, who was our TL. He was the founder of Falcon Bridge, Giant Yellowknife, Sherritt Gordon. And so my dad had a great mentor in life. And in the 60s, he went off and actually started doing his own exploration companies. He had 6 different public companies on the Toronto and Vancouver stock exchanges. So my life was spent in high school and in college, all at summer camps, or working the field all throughout Northern Canada. So it was just natural for me. I went and did a mining engineering degree, but it was in exploration at the University of Toronto. They had that option. And I topped it with a business degree. I did a bit of mining consulting. I actually worked, ironically, at the Bank of Montreal as a mining loans officer. And then I worked for Denison Mines in business development. And so it was kind of my start there before I joined Seymour and Pierre.
Okay, great. So then, right. So then Seymour Schulich and Pierre Lassonde had this great idea at one point. I think they were working for Goodman and Company, and
Mhm.
they decided, they said, okay, there are these, like, we know these landholders out in Nevada that own these royalties on properties that are producing. Should we go out and maybe try to acquire those and maybe form a company? Can you talk about how Franco Nevada started and how Pierre and Seymour started the company?
Well, it's even a more colorful story than that. So we were actually, I joined after Denison Mines. I joined to be Pierre Lassonde's assistant at Butel Goodman. Just so you understand, Ned Goodman was one of the founders at Butel Goodman. He went off to form Corona Mines, at the Hemlo camp. And so Seymour Schulich, who was the oil and gas investor, adopted Pierre Lassonde to become the new mining investor at the pension funds. And they were doing exactly what you're doing, running other people's money and running specialized gold funds. Pierre had 2 gold funds, and I was his assistant, and I learned a lot in terms of the investment side of the business. And this was 1987. I joined them that year, but they had on the side created Franco Nevada. One, because Seymour liked to play poker in Nevada, and 2, Pierre liked to go skiing in Tahoe. And they thought, okay, having a junior exploration company on the side would be something interesting. Nevada was the cheapest place to find gold by the ounce, and so this was what they had. And the only challenge, as Seymour pointed out, is every year they would have to raise more money for the exploration. And he says, we need a cash flowing asset. I'm running oil and gas royalty trusts. They're tremendous cash flow, very dependable. Why don't we do that in the mining business and do that for Franco Nevada? And he asked Pierre, are there any mining royalties? And Pierre said, yeah, there is. So he went out, he bought for $2 million the Gold Strike royalty. This was 1986. And there was like a golfer, an amateur golfer going out for the first time, hitting his first golf ball and hitting a hole in one. This $2 million investment is now cash flowed over $1 billion. And so it was a genesis saying, this is a much better business to be in, buying a royalty on a property rather than being something that's going to cost us money every year as we try to advance the property. And so that was a genesis. I joined in 1987, just as it was getting to going, the year, and it was the same year that Barrick acquired the property and was really expanding the asset. And it's haven't looked back. It's been 38 years doing
That's awesome.
royalty-related businesses with Seymour and Pierre. I've been very lucky to have them as mentors.
That's awesome. So can you talk big picture about so you got involved, so they hired you on then to work with Franco Nevada, but can you
That's
talk
right.
broadly about just what the benefit is to a royalty company? So this was a new thing at the time.
Mhm.
What back then, what was the pitch in terms of the benefit to having a royalty company relative to a producing company? What's the
Mhm.
benefit now? I mean, how do you kind of think about royalties in the ecosystem,
Yeah.
in terms of the precious metal investment ecosystem?
Yeah, it was interesting because we were running, as I say, before Franco Nevada took over our lives. We were running these gold funds and pension funds, and we were always frustrated. And you must have the same thing too, where a gold company has a fabulous deposit, and then they go dilute it by doing other crazy things or big equity issues to chase something that's not as good as what they have already. And that was our frustration. We could identify what we think were fantastic ore bodies, and then management would do things that took it away from us. And the beauty of the royalty is you never get diluted. You get that 2% or 5% of the gold ounces off the top, no matter who's running the property. And it doesn't matter what they do on the corporate side. The other advantage is that, your first dollar is your last. Once you buy the royalty, you can basically forget about it because you don't have to put another dollar. There's never a capital call. There's no operating costs involved, no environmental issues. Trouble for an operating company, if they're buying a development property, when they on their purchase price, it's just the start of their spending. They got to actually drill it, you got to permit it, and they got to do the capital. They have to pay the operating costs. They have to fund the closure costs, and so they got all the risk associated with it, and it takes up all their time in terms of their mental focus. Nice thing is when we buy a royalty, we can build a portfolio of those, and all we're focused on is what are we going to buy next. We don't have to spend a lot of time managing those existing royalties. The other two is you get all the optionality on the upside of properties, and you don't have to pay for it because what will happen is when miners are, developing the properties, they don't want their mines to close, so they're going to expend more money, and they'll actually mine at the end of the life marginal ounces, just basically to take advantage of the capital they've already gotten on their properties. So it tends to extend the lives going forward. And the third advantage is we can build this big portfolio, and it's scalable. We can buy hundreds of royalties without actually having to staff all these individual assets. We can run it as a large portfolio. And we have over 430 different assets in Franco Nevada right now. 120 of them are cash flowing. I think it's very hard for any company's head office to manage 120 mines around the world. So we've got a scalable business right now that can be much more diversified and still allow us to just focus on that capital allocation.
Yeah, no, I remember when I first started working at Gabelli as an analyst for the Gold Fund, I did go up and visit your office, and I remember this, you were very kind and cordial, took me out to lunch, and your office at that point was was it like the RBC building or something like that, or
We're in the Commerce Court, the
okay,
CIBC
okay.
building, the
Yeah,
tower,
yeah,
main
right,
thing.
right,
Yeah.
right. CIBC, and I went up to the office, and it was just a few guys, sitting in an
Mhm.
office, not that big, and it's amazing that to have, you can have a $25 billion market cap company that generates as much revenue and free cash flow as it does, right? And has done so well with such a small infrastructure. It's really an amazing thing.
Well, I think that's the case in point. We want to actually, we're not much different than you. We're portfolio managers. We're building a portfolio of non-operated assets. So it has to be very scalable. And I think when we start thinking of ourselves like a mining company, that's when we're going to go down the wrong path. And so I think it's very important to think of ourselves as capital allocators and investors.
Right, right, right. Okay, great. So when you started, so then just to get to the history a little bit for Franco. So Seymour and Pierre started Franco One. and
Mhm.
then it was acquired by Newmont, and you guys went and worked for Newmont for a little bit.
That's right. Mhm.
And then out of that came Franco to what we know now as, the company that you ran as CEO, and which Pierre was the chairman of. Can you talk about like what happened between the Franco one going to Newmont and
Yeah.
then the IPO, and then and also what you learned working
Mhm.
for a big company like Newmont that wasn't, that small infrastructure, and
Mhm.
what you kind of took away from that and how that might have helped you going forward.
So this was 2001, and if you remember, Chris, gold was down to about $260 an ounce.
Yeah.
And so it was a very unloved sector. And Franco, Nevada, the original Franco, we were a powerhouse. We had a $3 billion market cap, of which 1 billion was in cash. And so we were sort of the lifeblood for a lot of companies out there in terms of what they needed going forward. We also thought we were looking for the largest unhedged gold company because we thought we can get a lot more leverage on gold and we were right. This was the bottom of the gold market. That was the call. We could get more leverage by getting on the tens of millions of ounces. We tried originally with Gold Fields, but ultimately the merger was with Newmont Mining to get the leverage as the gold price moved up. And with the merger, Pierre Lassonde became president. I became head of business development in Newmont. We both moved down to Denver. It was a privilege. I was always curious. I've been mining all my life. Here I could be with the number one gold company in the world and execute deals and transactions. And I think we learned two things. Is one, it's hard to control the costs. And so the trouble with operating companies is the costs go up every year. Employees have to get paid more. The mines, as they get more mature and deeper, or there's more stripping ratio involved, the costs go up, the grades go down. And so that's just inevitable. And so I think both Pierre and I were surprised that the leverage to the higher gold prices wasn't as high as we thought it would be in an operating company because of the increasing costs over time. And two is we were trying to focus the board on doing deals in terms of here we want to acquire these opportunities, et cetera. And when you're an operating company, it was amazing the number of distractions that occur. And so for Newmont, it felt like there was a crisis every week. We'd have executives in jail in Indonesia. We would have, demonstrations at the gates in Peru. In Ghana, they were cutting off our electricity. In Nevada, we would have a slide dump over the highway. And it was just like, so when we would come up to the board saying, we want to buy this new thing, the board was, we've got to fix all our existing problems first. And that
Yeah.
to me was the biggest issue is that you take your eye off the ball, which is the most important thing in this business, is allocating capital when the opportunities are there. And you can't be distracted by the day-to-day operating issues. And so that, I think the biggest thing I've learned, and we've tried to do with the new Newmont, keep the management team small, keep as many issues off the table as possible. If there's a problem in a mine site, that's the operator's challenge, not our challenge. We're going to be focused on allocating capital. So those are the biggest lessons, the margin erosion in operating companies and the distraction from operations.
That's great. That's really, it's amazing. And it's amazing how the royalty companies really have done so well. I mean, you guys specifically, compared to
Thank you.
the producers. So, what about, so, okay, so you then IPO, FNV, you're the new CEO,
Mhm.
and the company just had this great burst of success, did some really good deals, always was really on the cutting edge, in terms of structuring deals, in terms of getting deals on the right kinds of deposits. But can you talk also about just maybe culturally, or even from well, whichever, culturally or just, in terms of the capital allocation strategy, what made you so successful? If there was one key issue, and I remember you're talking about being a really good partner. Could you talk about what makes a really good partner, and can you kind of talk about how Franco has embodied that in its relationships with its partner, with its financing partners?
Yeah. Well, Pierre and myself, we've lived and breathed the mining sector all our lives. We love everybody in it. We're a big supporter of the industry. We know just about everybody out there, and so it's a great relationship. We've had de minimis legal issues with anybody in terms of assets. So quite proud of that. But I think it's a different aspect because we buy assets for decades. And the most important thing for us is the geological potential in the ground of those assets. Because we only make our money over multiple decades. And what happens with most companies and most of our partners is that management changes or new companies buy, especially if it's a good asset, they tend to be bought by larger companies over time. So we have to be very conscious that in our asset that we're going to have probably different partners over the decades. And so I think the most important thing is to have a clear, simple title on those ounces in the ground so that it's like a good fence for between neighbors. You need to have a good clean contract so no one questions it when they come up or challenges your property rights on those particular assets.
Right.
So I think that's the most important thing, and that's what I think creates good partnerships. If there's not even a opportunity to challenge those particular rights, so that's I think the most important thing. We like our current partners; we're supportive of them, but we're also conscious that a lot of them are likely to get taken over or consolidated over time. So we have to think long term.
Right. So it's really the geological potential of the deposit is what's really made you
That's the number one. That's the number one asset. We have to focus on our title on that and how do we keep it over time.
And getting really long life deposits or deposits that, because you were even saying with the with Gold Strike, I think, I was reading that at first when those guys acquired it, it was 1 million ounces or something, and now but they saw the geological
50
potential.
million ounces.
Yeah. And that's great.
But think of how many CCOs of Barrick we've gone through since 1986, since we bought that asset. There must be at least half a dozen.
Right, exactly. And it's just always just chugged and plugged along and generated the free cash flow. Yeah, that's great.
And it's still producing today. Yeah.
Yeah, that's great. Okay. So you started out as a small company. You started out with Seymour and Pierre, small company, Newmont. And then even when you were IPO'd out of Newmont, it was still relatively small.
It was 1.2 billion on the IPO. So
1.2 billion market cap. Okay. Yeah. So compared to 25 billion today, has the culling of deals changed at all between when you started, I guess, was that 2007 or 8, to today? Because a deal that might have been meaningful back then might not be meaningful, or I don't know, but I do see you guys doing these small deals, and you just announce it in your press release. And I also remember seeing you at the Denver Gold Forum a whole bunch of times. You're just sitting there talking with guys in the hallway, getting their information down, and just so it seems like nothing's too small. I mean, so has anything changed, or hasn't it?
Well, I think the original Franco, all we bought was pre-existing royalties, and now the business is matured that we're doing bigger financing deals. And so I think what's the change is we're dealing with bigger companies now. We've done deals with Teck and Glencore and Lundin Mining, and now Newmont, we're helping them, buy one of their assets today. So I think that's different. We have a respectability we never had with the majors before, and it puts us in a different league. But I truly believe it is a portfolio. And I think the nice thing about it is that buying these, what we call acorn assets, good exploration plays, I love them, especially if you can buy them near existing mines. We've done very well by buying like next door to Hemlo, the Interlake property. Ultimately, they mine to your boundary and they need to mine onto your lands. And then you can make a great royalty out of that. And we've done the same thing in the Kirkland Lake camp and all camps. Be close, get interest, even though it's junior companies, and that this is something that's going to be potentially turn into an oak tree at the end of the day. Right. What I'm most proud of is, we helped a little company back in the late 90s, Palangio, to buy the Detour property from Placer Dome. There was an old mine, they were shutting it down. It was up for auction. We put up $2 million, and ultimately we converted it to a 2% royalty on that property. And now, of course, it's gone through Palangio, Detour Gold, Kirkland Lake Gold, and now Agnico Eagle. Coming back to one of our previous discussions. It's now the largest gold mine in Canada. It's going to go for at least another 20 years. I believe that $2 million investment is going to generate over US $1 billion for us at the end of the day. And so I think that's where we can add a lot more value is, we'll do all the usual financing deals. They have at least the start single-digit rate of returns. If we're right, they'll get closer to double-digit as they find more ounces, but it takes time. But the real wealth creation comes from these little acorns that we can plant at the same time that we can't put press releases on. The deals are too small. But just look at the counts. When we came out from Newmont, we were only 176 assets. We're 430 now. We
Yeah.
just keep adding all the time.
Yeah.
Most of them are below the radar. We have to put out a big book every year just to list everything for people.
Yeah.
But I believe it's going to make future CEOs of Franco-Nevada look very good because those acorns have already been planted.
Yeah, no, that's great. I mean, one thing that we do talk about in terms of when people say, well, the royalty companies don't have the leverage that the mining companies have, that library that you have of that 400 and
Yeah.
change royalties, that is some of your leverage. So on the upside, when gold does go to $3,000, $3,500 an ounce, you
Yeah.
pull those off of the shelf, and all of a sudden, they're producing and they're sending you checks. So, so that's something else that's another nugget of value, I guess, for Franco that might not be appreciated today in the market.
And I think the analysts get it wrong on the leverage factor because they say, oh yeah, but, on our numbers, if gold goes up, $1,000 an ounce, that's huge leverage on the gold companies. But the trouble is they can't protect those margins, as we talked about before,
Yeah.
and they're going to change their mine plans to mine even lower grade, and their costs are going to be higher. The advantage for us is the costs never go up.
Yeah.
And another example, when I first joined Pierre and Seymour, my very first royalty I purchased for the group was the Castle Mountain mine in Southern California, run by Viceroy Resources. And that mine, it was an okay mine. We made good money. We collected our royalties over that time. Gold price went higher, so we did even better than the original estimates on that property. Then they closed the mine, they reclaimed everything and even filled in some of the pits. Then what happens? The companies come back again saying, oh, at higher gold prices, we think this is a mine again. They're going to mine out these pits again, put in all new infrastructure. But for the investors in those operating companies, it's not such a great deal. They're paying so much to build and close the mines. We get our royalty on the second mine for free. We don't have to pay a single dollar. We're not going to pay for any reclamation. We just have a carry, and we're going to make as much money on that last ounce in terms of margin as we did on the very first ounce because we're getting them for free.
Yeah.
And so that's the big difference in terms of the models.
Yeah. So, okay. So this is obviously great operating model. We love it. Shareholders love it. You guys have done really well. How do you, I mean, given the degree of competition in the sector now, how much room is there for other royalty companies? What do you think about, and like, how do you compete?
I always think we had actually more competition in the old days in terms of we were always competing against the bought deal from the brokers.
Right.
And there was a lot of long only funds for the gold sector. You're one of the actually survivors, Chris. But there used to be about 20 different gold funds, and whenever there was a new deal brought up, there's a whole game. You buy seed stock, and then you're in the initial issue, and then you build it up over time, and then they've all disappeared. They're all generalist funds or passive funds buying the index. And so we don't have that competition from the equity market that we used to. And so I think it opens things up. I think as well as the traditional banks and that used to do project lending, they're not in it. So I think our competition is a bit different, and that's the private equity firms are in the business and doing deals, but they have a very high hurdle in terms of they often are borrowing money. They need to have a quicker realization. So I actually look at it saying our job is easier and we have less competition in terms of long-term investors in the business, and we have a lower cost of capital. I think we're set up to win.
Yeah, interesting. Yeah, no, when you say the survivor, I always kind of contemplate. I told my wife I might get a tattoo of a cockroach somewhere, on my body. In terms of maybe that's what the survivor. That I'll take it.
All right.
But so right, and okay. So then, how do you also think about? I know that when we've spoken to you in the past, there's always been this concept of you're being kind of counter-cyclical, and that's when you have done your best deals, right? When the industry has kind of been on its heels, and you've been able to acquire these really long life asset like royalties or streams, really long life assets for companies that might have been experiencing some degree of distress. How do you balance that aspect of wanting to be counter-cyclical versus also wanting to keep on moving forward and do deals? And you guys just announced a deal this morning, which I think is going to be a great deal.
Yeah. The counter-cyclical part, it's easy because we haven't limited ourselves just to the gold sector. And I think, again, this goes back to the roots with Seymour Schulich. There's times when there was just a bit of when the equity markets were hot on gold, in the early 90s before Bre-X, you couldn't compete with all the bought deals that were happening. Everyone was overpaying for assets. And so what Seymour would be doing, he got us into so that 20 to 30% of our business was doing oil and gas royalties in Western Canada. And so we've said we can do up to 30% in non-precious metals in the company. And so the nice thing about it is the cyclicality of these metals and commodity prices take care of themselves. Whenever the gold price is a little lower, okay, we can afford now to buy more, and that's usually the best time to buy more. If we're getting if the oil and gas prices or base metal, like we have iron ore and base metals, they're looking weak, or they're a smaller portion of our portfolio, which happens with those lower commodity prices. That's usually a good time to add to that side, and so we're always trying to rebalance the portfolio. So it almost doesn't actually take a lot of insight from us. The portfolio is telling us you're now underweighted. Your normal 20% on oil and gas revenues. Now's the time to be buying. Or now that you're 80 or 85% precious metals, you can afford to do more non-precious metals at that time.
Okay.
So I think it's a way that allows us to grow and not overpay for assets when everybody feels compelled to show growth through the peak prices in the commodity markets. So I think it's been a great strength. I think we're going to have to continue to be diversified, and we'll just play the inverse cycles that you often have through these different commodities.
Okay. Okay, great. I mean, and then one of the last questions is really about, so there are a lot of people on the webinar now, so we're doing this live.
Okay, right.
And this, it hasn't come up, but I bet some people are thinking about it. In terms of Cobre Panama, that was a setback for you guys.
Yeah.
And it was, so again, this was one of your biggest assets, and the Panamanian government essentially shut down the mine, and there's still an opportunity for it to reopen. Can you talk about kind of what happened there? What that was, kind of uncharacteristic for Franco, how you keep on moving forward, and if you can just give us some background there, what your thoughts are surrounding Cobre Panama broadly, and then what the future might be.
Yeah. So I've been doing, as we said, 38 years of the business. And what we position ourselves in is to say, okay, we'll take the production risk in any operation. And we felt very comfortable with our technical assessments and projects and our geopolitical assessments that we said, we're really confident this mine is going to get built, it's going to produce the ounces, and we'll benefit from not only those production ounces, but from higher gold prices in the future and from the discovery of more gold over time. And the nice thing is we're protected. We don't have to worry about the capital operating costs, but also the mining licenses in a lot of these countries are concessions. We know the governments would tend to extort the operator, but it never changed our deal. As long as the governments, squeeze the operators, it didn't change our property rights on those particular deals. So we actually had a free ride over decades in terms of the operators would be paying more in local taxes, but we were paying our standard taxes without that challenge. And our own estimation was the rule of law, if we looked at these different assets, would protect us, and the governments wouldn't be so stupid to cut off their own nose on different operations, because it was hugely beneficial for their economies to have a Western operator, working to high standards and paying local taxes and creating high-paying jobs to have those operations going. So we've never experienced a government that's actually shut down a mine for political reasons. And so this has happened in Panama. I'm totally surprised because our own assessment was a business culture that was running the mines, but somehow it just got too politicized. And so we've taken it out of our books entirely. Luckily we're a cash rich. We got a diversified portfolio. We can ride this out. I think it's been taken out of our stock price. My own estimation, there's at least $6 billion to $8 billion in our stock price that's missing because of Cobre Panama. But I look at it as all upside right now. And I think the right thing is to give it time. That what happens is we have to have cooler heads to prevail. If there's an economic downturn, I think it's going to be even more compelling to say we need to have an asset like this that actually directly and indirectly employed 40,000 Panamanians. It was 5% of Panamanian GDP, represented 3/4 of Panama's exports. And to have that rusting, by the Caribbean Sea,
It's
makes no
crazy.
sense whatsoever. I totally believe it's going to be a mine again. I think we just have to look at it on a long-term perspective, not rush it. We have to give it time for the consensus to be ready to accept the mine again. So I see it as upside in the future. It's not in our stock, so there's no downside from it.
Yeah. Okay, great. And I mean, maybe before we wrap it up and get your ideas on the direction of the gold price, if you can just tell us what the real pitch is in terms of, I did always like that idea of Franco Nevada, the gold investment that
That
works,
works. Right,
right?
thank you.
Because
Yeah,
that's
yeah.
really good. And and there is a pitch where you get with Franco, you're getting a dividend, you're getting
Mhm,
growth, so the dividend should grow over time, and you're getting exposure to gold. And you don't get
mhm.
that with the bullion and with the
Yeah.
producers, you might not get it either. Can you kind of just give us that idea of like how is Franco the gold investment that works?
Well, I think, we're going to talk about the gold price and what we think about going forward. But for investors to buy gold, there's three things. They can buy the gold operating companies, they can buy the gold ETFs, or they can buy Franco Nevada, which is something I look at as in between. And the advantages we've talked about our advantages over an operating company, but the advantages you just mentioned relative to an ETF is we can actually grow the number of ounces that we have on our portfolio for free as people keep exploring our properties, and we're paying a dividend. Well, if you're buying the largest ETF out there, you're paying 40 basis points every year. And just to show you how costly it is, just look at the value of the GLD right now versus the spot price of gold. And it'll show you how much it's costed those investors by paying that annual 40 basis points over time. And so we've been able to not only pay a dividend now for 18 years, we've been able to grow it each year. So if you'd bought us at our IPO now, you're getting for a US investor, I think it's close to 10% yield on the original IPO investment in Franco Nevada. And everyone talks about our yield being too low, but it's you have to look at it in terms of it's a growing yield or a growing payout. And in terms of you got to look at total return because again, we're moving our share price up over time. If we had our share price where it was originally, yeah, you're getting that 10% plus yield, which is impossible for a gold stock. It has to be repriced.
Yeah,
So
that's great.
going back, does that answer the question?
Yeah,
But
yeah. No, no,
I
no,
just
that's
think
great.
I think the other expression Seymour and I used to use when we were in New York is, and you probably, Chris, you heard it, we're a gold ETF on steroids. We give you that dividend without the costs involved and additional leverage to gold that an ETF can't provide you.
Yeah, yeah, that's great. Okay, cool. So, okay, so yeah, I mean, so what do you think about, you've been doing this for an extremely long time. You're
Yeah.
focused on the gold price every day. Um, can you kind of tell us what you think about the direction of gold going forward?
Well, I think last week in the inauguration address, you heard the statement, a new golden era has begun. And I think the stars are aligned. And I've listened to some of your podcasts, and we've got good Asian buying, we've got central bank buying. The remaining shoe to drop is Western investment demand. And so what I'm watching every day now is ETF buying, and
Yeah,
it's kind of where it was net selling for the last couple of years. This year's kind of wavering, where half the days are buying, half the days are selling, but it's no longer the big net selling that we had, say, at the beginning of last year. And so I'm looking at it and saying our competition headwinds has been the S&P 500, the NASDAQ, the big tech stocks. Well, today I think they're not looking as interesting. And I think as soon as people are looking for alternatives, they're going to look at gold stocks in general.
yeah,
And they have so underperformed. And on a historic basis, gold operating companies are trading less than even base metal companies.
yeah,
In
yeah,
my 40 years of being in this business, it's something I've never seen.
yeah,
And so I look at it saying these gold stocks now are so cheap,
yeah.
and gold is set up for a real run. If we get any, with the less competition coming from these alternative investments, they're going to be looking at gold again. So I think we're set. I think your new president has said it exactly right. The new golden era has begun.
I agree. I hope so.
Right.
I hope you're right too. Okay, great. So we're just gonna open it up to questions from the audience again. If anybody's wants to ask a question, please type it into the chat. But one is as chairman, what's your leadership philosophy and how does it guide the company's direction?
So as chairman of Franco Nevada,
Yeah.
I'm trying to be a good chair, and I think that our board's always very conscious because I'm the ex-chair. My keeping my fingers out and let much management do their thing. I'm doing as much as I can, and you see, I haven't been to the conferences
Yeah.
lately. I think it's for the management team to make their own relationships and be the profile of the company. For me, it's just trying to keep to the DNA of what the original Franco. We made our money because we didn't want to run the yellow trucks, which was the
Right.
operators were doing. And we wanted to keep, the capital allocation and investor perspective going. We wanted to be the Berkshire company of the mining industry, not an operating company. And so my job, I find, is to remind we have new directors, we have management teams. They're often looking at, comparables. And I'm trying to say the comparables aren't mining operating companies. Your comparables are making money for the shareholders through good capital allocation and exposing us to where the ounces are going to grow going forward.
Yeah.
And I think that's my philosophy, is trying to make sure we keep the DNA for success.
Yeah.
And I'm trying not to get into the details of running any company deals or packaging the IR. It's making sure we respect the DNA.
The DNA, right, of just buying good assets and keeping it
And
tight, keeping it
focusing on capital allocation.
at capital.
And
Exactly.
yeah.
Great. Okay, cool. You know what? This is an interesting question about AI. Is there any use of, do you guys figure that AI could help in the royalty business in any way? Or are you thinking about it?
Yeah, I know they're using it, now to make, minutes for their different meetings, et cetera, and go review documents. But my challenge mostly on the geological side is most of the data is so poor geologically, all the drilling data and the locations. And, AI will always tell you,
Yeah.
we've tried it, I've seen it done on a number of properties where it's most likely that, you're going to have an ore body usually what it targets is where's there been the most drilling. Well,
Right.
that doesn't help you to find the real new greenfields properties where they have very little drilling. That's what we really need. So I think there'll be better targeting on this going forward. But right now, I think it's still, we're in the land business more than anything else. We're trying to get, an interest on good geological potential lands. And so the real estate business is pretty simple. We know where the good geology is already. We're just
Yeah.
trying to, be opportunistic when there's an opportunity to get an interest on those good geological lands.
Yeah. Okay. That makes sense. Yeah. It seems like there could be some, like in all of our businesses, something probably will happen at some point with AI, but still, um, there's a reason for us to exist, hopefully,
Yeah.
and for you to exist, definitely for you guys to exist. Um, there's another question here about crypto, and it says the Swiss government recently approved their reserve to hold other denominations past gold. They also recently unveiled a federal crypto token. As Switzerland's typically a leader in the banking world, do you believe that the rise of crypto and federal governments adapting their own tokens, that there's a possibility for the gold industry to face an interruption?
Yeah, I worry in terms of the biggest support we've had for gold has been the central bank buying.
Okay.
And I'm worried about if we have a new generation of younger bankers that think Bitcoin is a better gold reserve asset or a reserve asset than gold.
Yeah.
I think that's a worry. I don't think it's going to happen in the next couple years because I think central banks are very conservative. And what's going to happen with all the uncertainty and all things, I think it's going to happen in the next few years. And I
Yeah.
think the first refuge is go for the tried and proven. We want a risk off asset. And so if there's a real challenge, gold is still seen as the risk off asset.
Yeah.
Crypto, I think it's still a risk on asset. And
Yeah.
so I don't think it's ready. And I think gold is positioned for when you need that risk off. I think we're entering that time right now where you need the risk off assets.
Yeah.
But I take the point. Could crypto replace gold 10, 20, 30 years from now? I take a lesson from silver. Central banks used to be big buyers of silver for the reserve assets. Now no one cares about silver in terms of having that as a reserve asset. So we have to have the World Gold Council, active to make sure that we're making a strong case that this is the tried and proven risk off asset that the banks need to maintain. They don't need to take the risk on approach. It's just I think we need to make that selling case to protect the market for the longer term. So that's why we're big supporters of the World Gold Council. Both Pierre and I have been chairman of it, and we've tried to advance the cause over time. I'm very proud of what it does.
Yeah. I think one thing about the crypto, hopefully, or well, crypto, first of all, there's so many cryptos, right? So there's crypto. And so I just think that it's like if you're again, it's how could this go wrong? So when you were saying like you were the Newmont um president of Newmont Capital or whatever, and you the board would say, and they say we have this deal, and the board would say, wait, something could go wrong.
Mhm.
If you're on the board of a central bank somewhere and they say, okay, we could buy Bitcoin instead of gold to diversify. My first question, well, what could go wrong? I think if you hold the
Mhm.
gold in your vault, there's very
Mhm.
little that could go wrong outside of someone obviously invading the country.
Yeah.
Whereas if you own Bitcoin, what could happen with other crypto, blah, blah. I think the other thing with crypto versus gold is that countries own gold in the ground. So the United
Mhm.
States has lots of gold, Canada has lots of gold, Russia has lots of gold, China has lots of gold. So it's like, so in terms of, they already have some in the ground, but they don't have Bitcoin and they have it in
Mhm.
their vaults. I just think it'll be a really tough sell to start to, but anyway, that's my
Good.
little,
It's music to my ears, Chris. Love
my,
that.
my little rant.
Yeah.
Someone asked, could you discuss, Franco's buyback philosophy?
It's I think our purpose is in terms of is to get our share price to the maximum price possible. That's always been the number one objective, is we want to have the highest trading, highest premium paper in the business and provide the best returns to our investors. And in terms of buying back our stock, we think, no, we're better off buying more ounces in the ground. We still see projects, as we've demonstrated today. We've just allocated another $450 million to buy ounces in Ontario. There's deals still to be done. And so we're in still a growth mode for this company. And we want to make our dividend progressive. So it's 30% some of our payout for our investors. But we also want to be able to grow the company, and that means reinvesting in new deals going forward. So we're not ready to do a buyback because we want to keep reinvesting in the business and grow it.
Yeah. And again, I mean, now seems like a good time to do it. I mean, there's a comment here from Ed O'Shea, who said, on Friday, I was interviewing an investment managing company. I asked them why gold's at 2,700. They couldn't answer me. The investing world seems to have forgotten us. So I think that's the
Yeah.
truth. I mean, I think well, what's interesting is that like you were saying, is that the Eastern world hasn't forgotten gold, they're
Mhm.
buying, but the Western world kind of has.
Yeah.
And, if and when the Western world gets woken up to the idea of why they should have some gold, and like you said, maybe if these other things um, start to come off, like in tech or
It's
whatever.
inevitable. Even if the investors are asleep, the algorithms are all going to pick up that year-over-year numbers for the gold companies now are just taking off with these
Yeah,
higher gold prices. So
yeah,
the comparison is going to look very good. They're going to look cheap on their historical metrics,
yeah,
and they're going to be outperforming most of the other sectors. You've already seen that with the gold stocks and sector. So I think it's coming, and
yeah,
it's inevitable this year because the year-over-year comparison is going to be so strong. And I think we've had the maximum headwind already from the competitive tech stocks and the Nasdaq. I think now it's going to be people will be looking for alternatives. I think our story will be part of the narrative this
yeah.
year.
Yeah, so great time for Franco to be investing, as the Western world is not paying attention, just like you did this morning on a great deal on a really, really long life asset in a fantastic jurisdiction, one of the best places in the world to mine. So yeah,
Absolutely.
so we prefer for you to keep doing deals instead of buying back stock too. And again, it's a very, very important position in our portfolio. I didn't mention that, and it has been for a really long time, Franco. So
Right.
thanks, David. Thanks so much. I really appreciate your time. This has been a really great discussion. I hope everybody who's listening also enjoyed it. If you have any questions, please let us know. You can contact I've given my email. You can contact me, cmancini@gabelli.com, and I'd be happy to answer any questions that you have. So thanks, David. Really appreciate it, and hope to see you soon.
Chris, pleasure. Take
All right.
care.
Thanks a lot.
Chris Mancini, CFA, is an associate portfolio manager for the Gabelli Gold Fund. The above webcast is an excerpt from Gabelli TV that appeared on January 29, 2025. As of December 31st, 2024, affiliates of Gamco Investors Incorporated beneficially owned less than 1% of all companies mentioned. Gamco is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. The portfolio manager's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the individual portfolio manager and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the portfolio managers and may differ from those of other Gamco officers, portfolio managers, other employees, or the firm as a whole. Because the investment personnel at Gamco and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Investments related to gold and other precious metals and minerals are considered speculative and are affected by a variety of worldwide economic, financial, and political factors. Investing in foreign securities involves risks not ordinarily associated with investment in domestic issues. Funds concentrating in specific sectors may experience greater fluctuations in value than funds that are more diversified. Investors should carefully consider the investment objectives, risks, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800 Gabelli or visit www.gabelli.com.